Well, good morning, everyone. Thank you for taking the time to join us this morning. I think we might get started. We've allowed about sort of 4 to 5 minutes before getting things off the ground. So welcome everyone to our national webinar this morning, which is obviously navigating alternative lending. Again, thank you for taking the time out of your busy schedule to join us, especially given the time of the year as well, with June 30 fast approaching. We really appreciate your investment in coming along today. So the purpose of today's session is not only to give everyone joining us an update on the state of play in market and an update on all things like capital, but also to assist each of you with identifying opportunities within the short-term business finance space. Furthermore, we'll also ensure we run you all through the critical items to look out for when identifying, structuring, and engaging within the private lending landscape. So today I'm joined by my two superstar state managers in Ellie, Shedden, who looks after ACT, New South Wales and Queensland, as well as Caleb Tiller, who looks after Victoria, Tasmania and South Australia. And these guys will deliver the majority of the content, as they are the subject matter experts in everything we do in assisting brokers and their SME borrowers. So thanks for joining us today, guys. So throughout today's webinar, you will have the ability to interact with us by asking questions, and at certain points, I'll share these with Ellie and Caleb to address where appropriate, or toward the conclusion of the session. Should we not get the chance to address your question at the back end of the presentation, you'll find our contact details toward the back end of the slide deck, and you'll be able to scan a barcode and download our contact details straight into your phone. Before we get started, a quick shout out to the MFAA off the back of an amazing national conference last month, where some of you that are joining us today would have last seen us, as well as Deanne and the team at Finance and Coffee for assisting with promoting the session. And finally, to our aggregator partners and key broker partners, who I know many have logged in today, for all your amazing support and ongoing support of Oak. It's obviously really appreciated. So without further ado, let's get started, and I'll throw over to you, Caleb.
Thanks very much, Nick, and echoing your comments, thanks again to all the members who've taken the time to join us today. I just want to start by setting the scene a little bit, explaining who Oak Capital is, I guess. This is not so much going to be about pushing products and talking about interest rates and LVRs and things like that. Today is very much an educational session, but I want to start by effectively setting the scene to give anyone on the webinar who's not familiar with Oak Capital a bit of insight into who we are and where we sit in the market. So firstly, it's important to understand that we are absolutely not a bank. We essentially exist to help when the banks can't. So that's the first point. And secondly, we are not here to provide 30-year mortgages on home loans. We are a commercial lender. We only lend to companies, and we are a short-term funder. So with that said, I guess the things that we specialize in and the areas that we play in, clients that have credit impairment, they can come to us, they can have a solution. We can be very flexible around assessing income for serviceability and things like that. We're not as rigid as the likes of a bank. We're happy to consider lending on all security types. We don't have postcode restrictions. We, in particular, are well known for being able to settle very quickly. So we have quite a unique product that allows us to settle loans in as little as 72 hours. And so all of these things effectively position us in the market to assist when the banks can't. I'll let you continue, Ellie.
Thank you, Nick and Caleb, and hello, everyone. Echoing what you've both said, it's great to be here and really appreciate the time. It's great to be sharing insights on what we're seeing in the market, as well as having the opportunity to talk about the non-bank space, which I'm personally really passionate about shining light on solutions that we can provide. Now, I understand that navigating the space can be quite daunting, and particularly for brokers that don't play in the commercial space. So hopefully today we can provide some insights and some tips and tricks to ensure that you're not only not missing out on opportunities to help SMEs, but that when you do utilize alternative lenders, that you're going to the right lenders that are doing the right thing by your borrowers. So essentially, the way I like to describe alternative lending is you have your major banks, which is your mainstream lending, which typically deal with your clean clients only and 30-year loan terms. Then you have your second tier and non-conforming lenders. Now, these typically comprise of your La Trobe's, your Liberties, and your Peppers of the world. They do 30-year loan terms and do have a few more requirements around income, security types, and serviceability. And then you have your true alternative lenders. Now, alternative lenders do comprise of many different types of private lenders, and this may include balance sheet lending, family offices, peer-to-peer lending, institutionally backed funders, and investment fund lending. Now, it is really important to know that when you're dealing with these lenders, where the money is coming from and who these funders are. So a few point of differences with alternative lending, that typically terms are 12 to 24 months. Major credit impairment is considered and is okay, subject to the exit strategy. Again, echoing what Caleb said, really flexible around income. And just in terms of how Oak Capital is structured, so we're Australian owned and investor backed, and we operate 2 contributory mortgage funds. So this means for brokers that when you're dealing with Oak Capital, we can be really flexible and commercial when it comes to decision making, and we're able to settle transactions quite quickly. It's also really important to know that when you're dealing with these lenders, that they have all the appropriate accreditation, licenses, and ASIC licenses. Thank you.
So in terms of what we're seeing at the moment, we play in an interesting part of the market, and I guess the last 12 months has been particularly interesting because we've had this rapid increase in interest rates. We've had, as a result of that, some cooling in the property market. We're all no doubt well aware of the issues around inflation, which have impacted the building industry, and the ATO trying to deal with a debt issue on behalf of the federal government at sort of chasing down company directors and things like that. So we are absolutely seeing this start to come through. I think, it's probably taken a little bit longer than we expected, but a lot of the clients that are having issues because of the points I've just raised are needing to seek alternative finance solutions. And that may be that they need to finance their way through an ATO debt, or they're having cash flow problems and they need to sit with a lender for 12 or 18 months and have their interest capitalized. They're basically looking for a unique, tailored product that will suit their needs, as opposed to a bank facility that is quite rigid and has, all the hurdles that you need to be able to jump over to qualify. So, I think it's important for brokers to understand that there are lenders out there that are going to be able to help your clients that are experiencing issues as a result of these points. And Oak Capital exists to service these clients in particular.
So on the back of that, as Caleb's mentioned, we are seeing a lot of distress due to COVID and inflation. And I might just delve into a little bit more about the ATO cracking down. So a DPN is known as a director's penalty notice. So this now allows the ATO to go after directors' individual assets, whether it be residential or commercial property, which was prior quarantined within the business. So do know that if you have a borrower that does require a tax set to be paid out, Oak Capital have the ability to cash out on residential or commercial land to help these guys through a tough period. We're also seeing a number of higher LVRs. Now, unfortunately, that's not the space that we play in. We're typically around the 65 to 70% mark on commercial, on residential, and 60 to 65 on commercial. We're also seeing a large number of second mortgages, and I'm finding that the main reason for the second mortgage inquiry is, number one, turnaround time. So as we know, banks may take up to 2 weeks to discharge. You may have a borrower that has to cash out to complete a purchase, or has a really urgent business use that they need to cash out for. We're able to settle second mortgages in a matter of 2 to 3 business days without the requirement of a deed of priority. So we're seeing second mortgages because of that, and as well as borrowers being afraid to take their lending away from mainstream lending. So they're just looking for a short-term second mortgage, and then they have some sort of clearance for the debt. We're also seeing a large number of serviceability issues on the back of the rate increases and cash flow problems. We can navigate around this subject to how a loan may be structured. So if you have an applicant that may be quite asset backed and they have the ability to capitalize interest, it could be a bridging transaction or there may be a sale. We have the opportunity to look at these transactions with capitalized interest, as well as partially complete construction, on the back of developers finding it pretty hard at the moment. We're seeing a large number of these. So the way that we can look at partially complete construction is on the land value or in the current as-is value. A lot of funders won't consider partially complete construction, but we absolutely can. We also like to understand the sponsor's asset position. Do note that we don't do traditional construction funding, but anything construction or development flavour, whether it be acquisition or cash out for development, a residual stock, O Capital do have a lot of appetite for. Thank you.
So one thing I'm really big on is trying to educate brokers about our market, because I think most brokers accept that there's been this enormous growth in residential lending for 10 or 15 years. But moving forward, the opportunity really lies in commercial mortgages. And it's time to start to dip your toe in the water and really get to understand the space. We've pulled some statistics here just to give you an idea about just how big this opportunity is. There's a touch over 2.3 million small and medium businesses in Australia. They all have debt requirements, or most of them, I suspect. And quite often with the way small businesses are run, potentially wanting to minimize tax or whatever it might be, there are obstacles and hurdles in the way of them accessing bank funding. So the chance for yourselves as brokers to diversify your offering to clients and start to pick up commercial debt is absolutely huge. Interestingly, point 3 there is a funny one for me. We've seen an enormous growth in our business. You know, since I joined the business 5 years ago, our volumes have quadrupled. But interestingly, the private debt space is still relatively small as a percentage of all commercial and corporate debt. So, you know, the private mortgage space currently accounts for 11% of all business debt. And, you know, comparing that to the United States and the UK, for example, where the market share for private lenders is somewhere between 40 and 50%, this private lending space is going to be a huge area of growth over the next decade. So, as I say, I encourage brokers to learn it, because what generally happens and what I'm seeing is that a broker who maybe hasn't taken the time to understand this space will either miss opportunities or they will get the opportunity, not necessarily know how to handle it, and they will handball it to a more experienced commercial broker. So the time is now to essentially equip yourself with the skills to be able to take on those opportunities. It obviously is a great opportunity for yourselves to add revenue to your businesses and advance your skill sets and you know, pick up new clients. Lastly there, interesting point, since 2020, we've only settled transactions for 342 brokers. Now, you know, myself personally, I think I've done, you know, nearly $250 million in lending over that time. Since I started in the business, which was 2018. And that's only been done with 76 brokers or something. So it's a small handful of people that really understand this market and support us, which is great. But the point there is that you're competing with far fewer brokers for the opportunity, as opposed to being out on the hunt with 18,000 brokers for the residential mortgages. So yeah, I'd encourage you, if you want to take the time to get in touch to learn more, you know, feel free. We're always happy to help.
Thanks, Caleb. And before I throw to Ellie to go through the next slide, we've actually got the first question that's come through from Corey Sullivan. Thanks, Corey. Pretty simple one, so I thought we'd address it now, which is, can we fund land banks? So, Caleb, I might get you to just quickly touch on that. We're probably going to cover it in the next few slides, but let's just quickly touch on that now.
Yeah, we absolutely can. So we don't really have a limitation around what assets we will fund. The beauty of what we do is that we can be really flexible to tailor a solution. So your client would come to us and say, this is an asset that I want to buy, or this is an asset I own. It's, you know, 20 acres of land in Tarneet, which will be for future development use. Subject to our appetite and how much exposure we have on the book to land, we will then make an offer to you. So, you know, if we haven't got a lot of exposure on the book, maybe we push a bit harder and we maybe do 55, 60% LVR on a good day. If we have a lot of exposure and we're not seeking that type of asset, then perhaps we just pull the LVR back a bit and you might get something from us in the range of 40 to 50%. So we will always endeavour to make an offer. We effectively manipulate our LVRs and our rates based on our appetite to try and provide a solution for your clients.
Thanks for that, mate. And I'll now kick on to the rest of the preso. Thank you. Ellie, over to you.
So whilst, we talk a lot about what we can do, it's also really important to highlight the risks in this space, particularly when you're dealing with other lenders that you may not know a lot about. So we do encourage you to always do your research, and just a few red flags here, particularly in our space. So charging large upfront and non-refundable fees. Now, Oak Capital do not charge any upfront non-refundable fees. When a lender does require that, we do urge you to look into that. That's typically a red flag. Another thing is when terms seem too good to be true. We also do encourage you to read the fine print. A lot of the time when the term is too good to be true, it typically is. There may be hidden line fees, hidden exit fees, default interest, or they may not even refund capitalized interest. And a lot of the BDMs at Oak Capital are very well trained in reading other lender offers. So if you do get an offer that you're not quite sure, please reach out to your BDM and we can help you work through it. And websites that don't disclose who owns the business, as well as whether or not they have the appropriate licenses, accreditations, and on major aggregator panels. So they're just a few things to look out for when dealing with other lenders. And on the next two slides, we'll actually go through the do's and don'ts. And we can also actually share the do's and don'ts with you if you're interested.
Yeah, good call out, Ellie. Thank you for that. And just briefly on the aggregator component, if you've got lenders that play in our space and they are on aggregator panels, particularly the larger panels, it means that they've gone through a pretty strenuous due diligence process. And Oak being on majority of the major aggregator panels now, it should give you that added level of trust that you're dealing with, I guess, a real lender that will always do everything they can to do right by the broker and, of course, the borrower as well. So I just thought I'd quickly mention that before I go into the do's and don'ts. And to your point, Ellie, we absolutely can provide these post the session today.
So yeah, look, as a part of our commitment to education, we've put together the do's and don'ts of private lending. And as Ellie said, more than happy to share these with you. Get in touch with us after the presentation. Effectively, I think what happens in our space some of the time is that by the time you've, as a client, gone to a bank, maybe then you've tried a second tier lender, and at the end of the line, you're starting to talk to alternative or specialist funders. There's often a time pressure there, and some lenders, unfortunately, can be a little bit opportunistic and take advantage of that time pressure. So the do's and don'ts are really designed to give you some guidelines on how to approach this space. And so firstly and foremostly, I think there are so many lenders in our space who, they pop up one week and they're gone the next. And so it's so important to understand who you're actually dealing with. Where, as Ellie said earlier, where is the money coming from? How are these people funded? So point one is do your research. Don't engage someone that you've never dealt with before. Pay an upfront fee. You could be promised the world, and there can often be bad outcomes. So do your research. Are they online? Do they have a social media presence? Are the owners of the business online, or is there no about us page? Are they invisible? Because that's a big red flag. When you're getting terms from a lender, ask questions. If it sounds too good to be true, like Ellie said, often it is. And as an example, there's lenders out there who will offer a really cheap headline rate, and they hide fees, whether they be monthly fees or exit fees, to disguise how attractive their offer is. So as an example, you might get a great headline rate, but then there's a 0.2% a month management fee. So naturally the interest rate is then 2.4% higher per annum. Clients who are in a hurry, have an urgent need, might jump at the headline rate and not realize how much they'll be paying. Confirm with the private lender that they actually have the money. It's a talking point at the moment, because as the market deteriorates, more and more loans are being needed to roll over. And what that means for a lender is that the money's actually tied up in that loan for longer than they expected. and they're relying on raising new capital effectively to be able to continue to fund loans. And I have had brokers contact me recently where we've priced a deal, lost on price, and a week later they've come back to me because the other lender that offered the great rate hasn't actually been able to come up with the money at settlement. So really make sure you're doing your due diligence on how the lender is funded, how long it takes them to raise money, so you can be guaranteed of a settlement timeline. Read the fine print to confirm what happens in the event of a default. Pretty critical. Obviously, defaults aren't a nice thing, but in our space where we are playing with clients that have, potential issues, defaults do happen at a higher rate than in the bank space. So it's important to understand what the repercussions are if a default occurs. Second mortgages. So there are lenders out there who won't actually consent to a lender registering a second mortgage behind their first, and that may actually be an active default and put their first mortgage into default. So worth confirming that. A point on us, we don't require a deed of priority with the first mortgagee. What that means is we don't necessarily need to engage the first mortgagee. We can offer a second mortgage. We register our mortgage without needing consent. So a lot of second mortgage lenders will want that deed of priority so that their debt amount is recognised by the first mortgagee, and that can be a reason for the first mortgagee to kick up a stink. So worth questioning whether or not the second mortgage needs a deed of priority. Worth understanding, is the lender the party that's going to be registered on the title? Because there are funds out there where the direct investors actually prefer to be registered on title. And what that can mean in the event of a default is that the deal can effectively be handballed to the investor to go out and recoup their own funds. And that naturally can end pretty messy. So important to understand who's on title. And lastly, I guess it kind of goes to where the money is coming from. There are lenders out there that, are referred to as lend-to-own lenders. Now, maybe that's a developer who's had a particularly successful decade. They're now sitting on their hands waiting for the market to cool, and in the meantime, they decide to do some lending. They're not going to be disappointed if a client with a development site defaults, because they have the capacity to go in, take over the site, finish it, and actually make more money. So again, it just speaks to asking enough questions, find out where the money's coming from, what's the background, how long's the lender been around, and who's involved.
Thanks, Caleb. Apologies, the slide deck had a bit of an issue there, so apologies everyone if you saw what I saw on the screen with multiple slides jumping around. I'll throw over to you now, Ellie.
Thank you. I suppose this slide echoes my prior slide in terms of don'ts and what to look out for in the space. So it's really important, don't sign a letter of offer unless the loan is absolutely proceeding. And the reason that we advise this is because once a letter of offer is signed, more often than not, the lender is then able to go after their upfront fees or their establishment fees should the loan not proceed. So really important to know that you've done your thorough due diligence and ensuring that the loan is absolutely proceeding. If you're waiting on a lender to decline your loan and you've got another private loan running in the background, do not sign that offer until you know that it's proceeding, until you've looked through all the terms and conditions, until the valuation has been completed, and the client is absolutely aware that if the loan does not proceed, it is highly likely that the lender will unfortunately be able to go after their establishment fees. Also, as I mentioned before, don't pay any large upfront commitment fees. That's usually a red flag and indicates that lenders that do this aren't quite as reputable, and a lot of the time these fees are not refundable. Don't sign anything without confirming all the potential consequences and costs. So again, really important, as Caleb mentioned, to go through what the default interest fees could be, what could trigger a default, could a second mortgage trigger a default, if the client intends on knocking over the house and building on the land, does that trigger a default? Do check that if the client is fully capitalizing the entire term, if they pay it out early, can they get the interest returned? Are there any exit fees? What are the penalties? We always do encourage brokers to confirm everything via email. That way you can document any correspondence. Obviously, if you have a phone call, you can't exactly document everything. So we do recommend that when you're liaising with these lenders that you may not be 100% sure about, make sure that you do document everything in writing. And don't forget that private lending is a no-nonsense business. Given that we are in the non-regulated space, recourse is a thing. So unfortunately, if your client doesn't make their mortgage repayments or they do go into default, these lenders do have the ability to repossess properties. So it is a no-nonsense business. And do remember to ring us at Oak Capital, whether you need funding or whether you need help with navigating these lenders or offers. We're always more than happy to help. Thank you.
Thanks, Ellie. So I guess we've touched on some educational content and we're going to start to talk a little bit more about what Oak Capital does so that when you start to see scenarios and identify opportunities, you can have a feeling for what it is that we do and hopefully give us a call to help. So firstly and foremostly, we offer interest rates from circa 9.49% right now. We've actually done pretty well as rates have gone up to manage our investors' expectations around returns. And therefore, 9.49% in our space is actually very sharp. We touched a little bit about serviceability. We can be really flexible with serviceability. We have the ability to capitalize interest. So if there's a situation where the client doesn't want to make repayments or can't, and the exit strategy makes sense, there are times where we won't actually require income. We can build in all of the interest and fees for the full term of the loan. We talked a little bit about being able to settle quite quickly. The way we do that, and this is very unique in market, we have a product where our investors will rely on our own desktop property research, and we employ 3 full-time valuers, soon to be 4, who will sit there and research a property and generally get that done in a day as opposed to waiting a week for a certified val. And that really helps us to speed up the settlement process and get it done in as little as 72 hours. We spoke about adversity. So ATO debts are topical at the moment. We're seeing a lot of that. More than happy to cash out to pay the ATO. We will want to control that payment. We won't cash out the money to the client's bank account and hope they pay the ATO. Touched on capitalized interest. I've had a few deals of late where clients are actually, their entities are in administration. Maybe there's a bankruptcy proceeding. Most of the brokers out there will see that as a red flag and think potentially there's no lender out there that will help. I've actually very recently funded a client through an administration where previous default with a lender appointed the administrator, and the administrator was there effectively to liquidate all the company assets. We were able to come in and gear up on those company assets and some personal assets as well to refinance the existing lender's debt and have the administrator removed. So the point there is that the client was able to buy themselves 12 months to sell those assets down on their own terms and get a better outcome. Cash out's a big one. We do a lot of cash out. And right now, with development funding quite hard to come by, a lot of developers are happy for us to gear up on their residual stock or even on their owner-occupied residence to help acquire the next site or use those funds for construction. So keep us in mind for that. We can do unlimited cash out up to $5 million. We do second mortgages. So that, for those that don't know, is where there might be an existing mortgage on the property. If there's equity sufficient enough to allow us to come in and secure an additional mortgage behind that debt, we can. So it's a good, quick solution. They're quite expensive, so you wouldn't want to keep it for long, but if there is a need for 3 to 6 months, that can be a great outcome for a client. And the last point there is we do facilitate self-managed super fund purchases. We don't do a lot of it, but we absolutely can. On the can't side, we do not offer regulated loans. We do not lend to individuals. We do not offer 30-year home loans. We're here to provide a solution for self-employed people. LVRs, you won't get an LVR like you would at a bank. We don't offer 90% LVR loans with LMI. It's strictly 70% and under right now. We don't offer construction products, although we will, as I touched on, cash out on established assets to help you fund a construction, but we will not provide a typical construction facility. We are a short-term lender, so we're here to offer terms typically under 2 years, but if you had a need for a 3-year loan, we're happy to have that conversation. It may just be at a slightly reduced LVR. And I've said we lend on all asset types. That excludes mango farms in Northern Territory, which I've had a couple of. So we won't do the super quirky. They are difficult to lend on, but if you have a motel, for example, we would make an offer on a motel. It'll just be at a low LVR. If you had a farm regionally, same kind of thing. We'll always endeavour to make an offer, but on your more specialised securities, expect a lower LVR. And the last point is unsecured lending. We run 2 mortgage funds, so everything we do is property backed. We don't do anything unsecured.
Thanks, mate. And before I jump on to the next slide, talking about the 3-year terms, I think another point to call out for us is that our minimum terms typically 3 months. So, we can offer really short-term solutions, particularly in those bridging situations. So I just thought it's quite pertinent just to mention that. We did have another question from the audience, but you've just actually covered that off, Caleb, which was around the regional farm zoning. I think you've sort of spoken to that enough there. So I'll keep progressing through, and I'll throw to you, Ellie, for the next slide.
Thank you. So a few recent changes with Oak Capital. With Oak Capital, we're not only custodians for our investor funds, we also want to ensure that our borrowers are able to exit our terms quite easily. So we've made a few changes to our appetite around LVRs being slightly reduced and lending on less risky assets. We still have appetite for more specialised security. However, we have pulled back a little bit. And as we know, cost of funding is rising. Now, what I should point out that Oak Capital interest rates are fixed for the term of the loan. So our borrowers know what rate they're going into, meaning our borrowers are not suffering from interest rates increasing during the course of the loan. Now, there are a lot of other funders in the market that do, in our space, move with the cash rate. And these are typically your institutionally funded lenders, and something to also look out for when dealing with other lenders in this space. Again, we can consider unique and risky asset, however, nothing overly specialised. I most recently funded a cinema, which was in a regional town. However, the borrower had a pretty strong asset position. So for us, when we're looking at these more specialised deals, we do ask that you, I suppose, show us what the client's A&L is. If they have a pretty strong asset and liability position, what we're really good at Oak Capital is being able to pull a deal apart. If we can take an unregistered second mortgage over an additional asset, or if there's another way that we can structure these trickier transactions, we can absolutely consider it. And again, our LVRs have reduced slightly. So prior to COVID, we did go up to 75% on second mortgages. We've pulled back a little bit to 70%, and we have pulled back a little bit on your larger loan sizes. But again, if we can look at the client's A&L and we can structure a deal, then, and the exit strategy makes sense, then we can absolutely consider these more, I suppose, risky assets and unique transactions.
So it's easy to get confused and bogged down in policy, particularly dealing with banks. There's lenders out there who you will use because they have the best serviceability, or they have a policy where they'll allow 3 units on one title, whatever it might be, all this policy stuff. I like this slide because it talks to just how simple a process it is to deal with Oak Capital, and how it is that we actually go about assessing whether a transaction is something we would consider. And it really is as simple as understanding if the security that your client is offering to us is acceptable to us. And I don't mean acceptable in terms of a postcode restriction or any kind of policy. We will literally, I'll be on the phone to you, I'll Google the asset, you tell me where it is and what it is. I'll be able to tell you on the spot, look, this is a bit unique. I would do a house in Hawthorn at 65. On this one, we're going to be at 55. So it's about coming to an understanding around how comfortable we are with the asset, then picking LVR that we like, and then understanding how we're getting our money back. They are really the fundamental things we consider when we're looking at whether or not we're prepared to consider a transaction. Now, all the bits in between, we can kind of fill in the gaps. So you might tell me that your client doesn't want to make monthly repayments or can't. That's fine. We'll tailor the facility to meet their needs and capitalize their interest. You might tell me that the client's got liquidation event like I spoke about. That's fine as well. It just comes back to, do they have sufficient assets at the right LVR and a realistic exit strategy to be able to repay our debt? And if they do, then we'll come in and pay out that issue. So don't overcomplicate it. Give us a call on everything that you think might be a deal, and we'll tell you how we feel about it, and then offer terms from there.
So I like to talk about our loan process because speed to market for Oak Capital is a major selling point for us. And I suppose we understand that when a transaction comes to us, it is at the pointy end. So a quick yes or no is really important, and our sales team are really well trained in being able to filter through these deals pretty quickly. So I encourage you that if you have a really urgent deal, to pick up the phone, send an email, you will get a fast response. That's what we pride ourselves on. So essentially, once you get that yes or no, and hopefully it's a yes, we'll filter quite a few questions to get there. Our application process is really simple. Once you complete the application, you'll then email it to us directly. And more often than not, as long as the application is well completed, our credit team will pick up the deal and have the ability to issue you a formal approval within 4 hours. Now, it's also important to know that when you get a letter of offer from Oak Capital, we have done our thorough due diligence. It has not just come from a BDM, which some other funders in the market do. We've done our credit checks, we've done our company searches, we've verified income, we've started property research. So that offer is the real deal, and the conditions on that offer will be the conditions that carry on through to settlement. So essentially, once the offer is then signed off by the borrower, which is issued via e-sign, we then have the ability that once all credit critical items have been completed and our internal valuation team have completed internal val, which can be same day, we can instruct 2 mortgage documents within 4 hours. So essentially, by day 1, we should have been able to issue the offer, have the internal valuation done, and documents instructed, which enables the borrower to then, on day 2, go and sign up documents, ensuring that they're completing all credit critical items, and we should be in a position to then be able to settle by day 3 or 4. So it's really important to highlight that our process is simple, streamlined, and all hands on deck to make these urgent deals happen.
Thanks for that, Ellie. So, look, guys, that effectively brings us to a conclusion on the actual presentation today. We didn't want to make things too sort of product centric. This was really around how can we help, I guess, educate brokers, particularly ones that don't necessarily play in our space or play in our space too often, understand, the market, our market in particular, and how Oak can potentially add value to your SME borrowers. We do have a couple of questions before we finish up, though, but the reason why I like to pause on this slide is it gives everyone the ability that's online here to scan the QR code onto their phone or device, and that'll actually then save our contact details there. It's just the 3 of us today, but we do have a broader team across majority of the states in the country. And should you want to understand who your BDM is, please connect with one of the 3 of us, and we'll be able to direct you in the right direction. So a couple of questions. I might give one to you first, Ellie, because you were just on the last slide, and we have touched on this a little bit, but just for the benefit of the person that's asked, that they just want to understand how Oak actually fund their loans. So I'll throw to you just to run through that a little bit.
Sure. So as I mentioned prior, so we're Australian owned and we're investor backed. We operate 2 contributory mortgage funds, a retail fund and a wholesale fund. So our retail fund comprises of like your mum and dad type investors. And then we have our wholesale fund, which is your sophisticated high net wealth investors, which obviously expect a higher return. And we fund our higher risk type transactions. So yes, Australian owned and investor backed.
Awesome. Thanks for that, Ellie. And the final question that's come through from today, Caleb, I might throw to you, is just around whether or not Oak pay trail. So there is an option there, but I'll get you to sort of talk through that if that's okay, mate.
Absolutely. So look, typically trail, doesn't exist so much in our space because the loans are short term. So, you know, a lot of loan, I think the average loan term across our entire book is about 7 months. But so as opposed to trail, what we generally find is brokers will dictate a larger upfront fee, and a typical introducer fee or brokerage on a deal for us is about 1.1%. So slightly higher than the banks on the basis that trail isn't generally included. Now, if you are a broker that desperately wants to do trail, you know, we can talk about it. What that would look like generally is a small loading to the rate, which would be paid to you at the time that the mortgage discharges and on the basis that the client hasn't gone into default. So we can work with you to look at something like that if it appeals to you. But what I generally see is most brokers want to earn their money up front at settlement as opposed to waiting till the end of the loan term.
Awesome. Thank you, mate. And I've just had a couple of people give us some feedback just around the detail that was included on that last slide. It looks like we've put my name under or over your photo there. So apologies for the confusion there, guys. So that, as I said, that sort of concludes the session for today. I just personally want to thank Ellie and Caleb. I think everyone would agree that, you know, everyone that's come in today would think that you guys have done an amazing job. So well done. And I think we've all walked away with something that we didn't know before entering the session. Again, if we didn't get the chance to address any of your questions, or you've got sort of post-session questions that you want to sort of run through it with us, or you've got a scenario that you'd like to discuss, please reach out to us. We'd be more than happy to run through any questions or concerns that you've got, and or any loan scenarios that you're looking to get settled, particularly given, you know, the time of year that we're in at the moment. So again, thank you for joining us today. We really appreciate your investment of your time and your ongoing support, of course. And we look forward to helping you and your self-employed customers both now and into the future. And yeah, have a fantastic day, and hopefully we get to speak soon. Thanks again, all. Appreciate it.
Thank you.
Thank you.